Awesome. Well, guys, again, thank you so much for joining me on another episode of How to Get Started as a Passive Investor. I do this webinar every single week, so you guys can learn just the basic ins and outs of passive investing, especially related to, apartment syndications and fund investing. But generally, these webinars are good for you. Like maybe you've tried to invest in a passive deal before, but got cold feet, or you've already invested in a passive deal and realized you made a mistake, or you're just so overwhelmed by all the information out there that you're not exactly sure where to start. If that's you, you are in the right place. This week, we are, I'm gonna skip over that because that's not current. Apologize, guys. But this week, we're gonna talk about what the capital stack is. We're gonna talk about how it applies to you and how it might affect your returns, and then how to tell what kind of stack you might be looking at in a particular deal. But let's talk about one of the biggest myths that investors tell themselves when they get into passive investing, and that is that they feel like that they won't make that high of a return. And we've kind of, gone through several different scenarios in which that just doesn't hold true, especially if you are taking great care to underwrite the operator in the market in the deal. You can actually have leverage returns, and probably the biggest leverage return you get is your return on your time, because you're able to leverage an expert operational team who has the ability to find deals, put together a team in that particular market, can get the lending, and can leverage other investor capital in order to access a nice deal. But if this is the first time we're meeting, I'm Whitney. I'm the Director of Operations and Investor Relations here at Goodegg Investment, and this is me and my crazy crew. And this is the whole reason why I invest in real estate in general, but definitely in passive investments. I started out in real estate investing in 2002, doing live-in flipping and house hacking, and realized I just had buckets of money coming in, but no real cash flow to where I could unlock those golden handcuffs from my W-2 job. It took me a few years to figure out how to do that, but my husband and I, eventually transitioned into rental real estate. And then as we started scaling, we realized we needed to scale faster to hit our income goals. And that's where we got tuned into multifamily real estate and passive and active investing in multifamily. And fast forward about 2.5, 3 years later with Goodegg Investments, we've closed over 27 multifamily properties. In addition to that, we have 2 self-storage and a mobile home park. We have over 6,900 multifamily units under management and a $850 million portfolio value. And what I get to do every day is work with you guys, our investors, and we have a nice pool of investors that help you and help us invest in these amazing deals. But like I said, this is just one part of a series that I do. We repeat it a couple times a year, but if you're coming in later in the series and you want to know what other information's out there, this is being recorded. You will get a replay link via email, and in that email you also have links to other videos for you to review. And if you're kind of newer and you want to understand of all these videos, which one should I take a look at first and in what order, take a screenshot of this slide. This kind of gives you a nice going through these first 10, 11 videos in this order will actually give you a very nice primer to passive investing. All right, so let's talk about the stack today, what it is, why it's important, and how it impacts you and your returns. Before we launch into our content, remember this is for educational purposes only. We are not a legal, financial, or tax advisory firm. So if we do get into any Q&A around that, make sure you're consulting with your legal, financial, or tax professionals and getting those questions answered and how they apply to your specific situation. All right. So this is going to be kind of a blend of 2 different presentations that I've done before on, the different types of capital stacks and what a capital stack is. Last time I broke these 2 up in 2 completely different presentations, and I realized I could create a greater impact with the investors if I blended them together. So let's just take a step back and define what a capital stack is. Another term that you might have heard is actually the waterfall, okay? So, and they're not entirely synonymous, but essentially you can, some people will, use them interchangeably, but the capital stack or waterfall really determines who, how, and when a partner, it can be a limited or general partner, gets paid in a syndication deal. Okay. And it's really important for you as an investor to understand where you are in the capital stack, and that changes deal by deal. Okay. Now, generally, an operator will have kind of a capital stack that they really identify with and they like, that they feel like appeals to their investor, and that creates alignment. But the capital stack can change deal to deal. So this is where you have to be very savvy and understand how to read the different documents, in the investment summary, and also the private placement memorandum, to really get a full understanding on, what the actual waterfall is. Okay. Now, one thing that I like to know, especially if you're new to passive investing, okay, the investor, the limited partner investor, is equity. They're not debt. Okay, so the limited partner investor is not borrowing money to or lending money to the general partner to go buy a deal. We are all pulling our funds together in order to take, purchase a deal. Okay, the limited partner, the distributions of profit and cash flow fall behind all expenses, fees, and debt on the property. Okay, the limited partner is not an expense on the property. Okay, that's exactly what it is. We're partners. We make money together. Okay, and when we are looking at the waterfall, we're really understanding what is the distributable cash flow, and who, how, and when will that get distributed. Okay, now, on a finer nuance level, the reason why you want to understand the capital stack, okay, or the waterfall, is it can impact your cash on cash return. All right, the cash on cash return is a before tax return an investor makes on the cash they've invested in the deal. It can affect the internal rate of return on the deal as well. Okay, this is the profitability of the deal between cash and equity that the investor sees. And it also takes into account when the investor gets their capital back. All right. It can also impact the velocity of which you get your money back as well. Okay. So really key, like in value add investing, when is the capital returned to the investor? Okay. Is it returned through distribution, a capital event like a refinance, or a supplemental loan, or is it really on the sale of the property? Okay, when your capital is returned, that can really indicate, if you, the investor, can actually take those funds and go earn returns in two places, accelerating your growth of your portfolio. All right, so let's just do a quick recap from a few weeks ago of what the capital stack will look like. Okay, so on the left-hand side, we've got debt equity. Okay, this is kind of like what stage we're looking at. We have to look in terms of risk. We have to also look in terms of priority of who gets paid what when. Now, the senior debt, they generally, especially if you purchased your own single family residence, there's generally a primary mortgage, okay, a senior debt on the property. They take the lowest risk, highest priority position on the asset, okay? So they get dibs on any cash flow coming in. All right, we have to pay that senior debt off first. Next is if there's any sort of mezzanine debt or second loan or supplemental loan on the property, okay? They generally will sit behind the senior debt, okay? So they take a little bit higher risk position. That's why if you take a second mortgage on your property, the rate's generally higher, okay? Because their priorities in payment to get paid back is lower than the senior debt, all right? Then we get the preferred equity class. All right. Now, as a limited partner investor, you might be all preferred equity, or you might be all common equity, or you might, invest in a way that you're a blend between preferred equity and common equity. And we'll take a look at those different options of investing. My preferred equity position sits behind the debt. Okay. But they're equity. They're just that. They're not an expense to the property. And they take a little bit higher risk, a little bit lower priority position. So if there's no mezzanine debt, the preferred equity sits right behind the senior debt. And you'll see a lot of operators using as preferred equity class in lieu of a mezzanine debt position. Okay, so that, sometimes you'll see that on a deal. Then we've got the common equity class. Okay, this will be, the combination of the splits between, the limited partner investors on the gains of the sale and also the general partnership. And that class takes the highest risk and lowest priority position. Okay, but this is also where the money is made for most investors. Okay, so if you have a very extreme low risk tolerance and you just want to get a check every single month, you might think about just being in a debt position on, an asset. But if you're looking to actually accelerate the growth of your portfolio, just know that these higher returns take on a little bit higher risk and a lower priority in the payment on the capital stack. Okay, now ideally, the operator is underwriting the project in such a way and mitigating risk in the project in such a way that to be actually realize your gains in the preferred or common equity class is very high. So again, that's why the operator is truly key in any investment. Now, let's look at the different types of stacks. Okay, I'm going to break these down into two. Okay, two different kind of like flavors, so to speak, and then we'll get a little more nuanced within each. But we have got our single tier stack. Okay, so we've got our senior debt position. Okay, it might be 70 to 75% LTV. We like to hover close to like 70, 73% LTV, loan to value on the property. And then, a common equity class would be a class A position. Okay, now notice, I'm going to flip back here. What happened to the preferred equity class? Well, in this common equity class, they might get a preferred return as well. Okay, so they might be a blend of a preferred equity and common equity. And then you'll have your general partnership, class B, common equity position. And when the gains on the property are split and excess cash flow is split, it's 70% to the common equity class A and 30% to the common equity class B. Now, as I mentioned, you can have, again, a few different, nuances to a single tier stack. They might get a 7% preferred return. So in this example, class A gets a 77% annualized preferred return based on the original investment. Okay. And then class B profits from anything past the preferred return. Okay. Now, this, what it means in the waterfall is that you have to replay all of class A first, make up anything in arrears to class A to get them to, 7%. So their capital is return, you make them whole, then you catch up all the preferred return, okay, if there was a preferred return on the deal, and then any remaining distributable cash flow goes to class B or is split. All right. Another kind of flavor is that you have a 7% plus a 70-30 split. Okay, much like we, drew out here. All right. So class A gets 7% annualized preferred return. Any remaining cash flow is then split 70-30 with 70% going to class A, 30% to class B. So how's the waterfall going? The waterfall will go, any unreturned capital to class A is repaid. And you make up anything in arrears to hit the preferred return. Okay. Then there might be a GP catch up where you get to distribute an amount equal to 30% of the cumulative cash to GP. Okay. And then any remaining cash is split 70 to 30 with going to class A and class B. This is where you got to read the PPM and understand what the classes are and who gets paid what when. All right. Another type of waterfall that you might see, which looks pretty similar, and this is the one that we generally will run on our deals, but again, it's not, you got to read the PPM. Okay, there are some, sometimes we have to change things around just slightly. We like doing a 7% annualized preferred return. We'll do 70-30 on the cash flow, 70% to class A, 30% to class B. On the capital side, we'll replay anything, all the unreturned class A capital. We'll make up anything in the preferred returns to class A. Then we'll do a GP catch up of 30% cumulative cash, and then split 70-30 to Class A, 30% to Class B, up to maybe like a 13 or 15% IRR, and then 50-50 after. Okay, this is all in a single single tier stack, capital stack. Then you got your dual tier capital stack. All right, and if you guys have any questions, make sure to drop those in the chat box. A dual tier stack, okay, we've got our senior debt, but here we've added in a preferred equity class. And remember, the preferred equity class, even though it's equity, might look and kind of feel like a debt position on the property. But remember, it's still equity. It's not debt. It's not an expense. All right. Now, in this particular deal, okay, we can do two passive tiers. And when we look at the cash flow, Class A might get 9% annualized preferred return, no upside on the deal. Okay. Preferred equity here generally does not participate in any of the capital events on the property other than the sale. So if there's a refinance or a supplemental loan, they don't get their equity returned. Now, why would you do that? Okay. Well, one, you might be trading, again, a higher position in the stack for a higher preferred return. Okay. But also you're right behind the senior debt. Okay. Maybe you like that position. All right. Then there's a Class B, right? They get a 7% annualized preferred return, and then any remaining cash flow is split 70-30 with 70% to Class B and 30% to Class C. Now, the payback is very similar to that 7-pref, single tier stack I was showing you. We would repay any capital to Class A, repay any return capital to Class B, make up anything in arrears in the pref to Class A and Class B in that order. And then we would do a GP catch-up up to 30% cumulative cash, and then split everything 70-30 with 70% paid to Class B and 30% paid to Class C. Now, oftentimes when I have a conversation with the investor, it can go one of two directions. Their minds boggle. They're like, I don't know which one to invest in. Like, how do I know? Well, it depends on what your goals are. Okay. If you're just needing cash flow and you don't care about growing the upside on the deal, if that's your goal with your portfolio, Class A might be a better position for you. If you are wanting to actually grow the net worth of your portfolio, Class B might be a better position for you. It really depends on your investing goals. And really, one things that a dual tier stack does is allow us to bring in more investors who have differing goals and have them all share in the same investment, which is super cool. All right. So then we've got a full-on GP catch-up type model. This isn't something that we do on our particular deals, but this is just what it would look like. Okay. Now let's practice a little bit. Okay. If you're looking at one of our offering memorandums, okay, you might come across the financials page and I'll have a graph that looks like this. All right. We can glean a lot from this graph. Okay. One, we can tell that this graph actually tells us that this is a dual tier capital stack. Okay, meaning we have not just one class in the general partnership, we've got two classes of investment and then the general partnership. All right. So we're looking at a class like this, a stack like this. All right. The Class A, the preferred investor, they're getting 9% preferred return and no upside. Okay. We can also glean where, what that investment structure looks like for Class A. All right. So they can assume that they're, and it will be outlined in the PPM in specific detail, but we could probably assume from this offering memorandum that the Class A investor would not participate in any capital event on the deal. Then we've got Class B. Okay, Class B is a little bit different. Right here, they're sharing in the distributable cash flow. They get 7% preferred return to the investor, and then they get 70-30 split with the sponsor thereafter. And then on the capital gain side of the deal, membership ownership, when we go to sell the property, they'll get 70% up to 13% IRR and then split 50-50 thereafter. Okay. Now, again, you always have to read the PPM as well for the more detailed language around this, but this gives us a good indication on what the class structure looks like. All right, now this does impact the returns. Sorry guys, I'm not sure why I get this. Click that off. There we go. Okay, so if we're looking at, this is a deal that we did in 2020, okay? And here, again, like I said, there's an investor, there's a different type of investor that wants Class A versus Class B, or generally you can do a blend between the two, all right? Generally, it takes a little bit more to access Class A. You might have to make a minimum of $100,000 investment to access Class A, but you could probably break that up between 50K in Class A and 50K in Class B. And Class A will be capped, okay? It'll probably be capped at, maybe like 10% of the total raise or something like that. Okay, here, we can see where our Class A is making 9%, straight cash flow straight across the board, all right? They're getting no return of disposition, all right? So essentially, on a 9%, let's say if this was only going to year 5, that's like a 1.45x equity multiple, okay? This is a little bit bigger because, it's going on to, year 7. Here, we've got a couple of things that I want to point out. One, we've got our 7%, return, but our cash and cash ticks up. Now, look at year 1. Year 1 is at 4.4, okay? So remember, in our capital stack, we got to figure out in that PPM what's going on here, okay? If year 1 cash on cash is below the preferred return, you need to understand and ask, is that accruing? Is it cumulative? And if it's cumulative, what will happen is the delta between 4.4 and 7 will kick further. It can either be made up in cash flow in future years at a capital event, like a refinance or supplemental loan, or upon the sale of the property, okay? You wanna understand in that PPM when that delta is getting made up, all right? Here in this particular structure, we're just looking to hold the property for 7 years, no particular refinance here. We generally don't underwrite refinances in any of our numbers. We just don't want to be beholden to have to do it in that year. We want to make sure the market conditions are right. But anyways, there is a gain upon sale of the property, okay? So as you can see, this, same $100,000 investment or $1 million investment in this case yields two very different results, okay? So Class B generally is for somebody who wants to grow their portfolio a little quicker, is okay with a little bit pulled down in cash flow just a little bit, and is okay taking on that higher risk position in the capital stack to be rewarded to essentially capture a reward on the back end of the property at the sale of the property. All right, guys, that was a lot of information thrown at you. So if you have any questions, jump over to the chat box. I would love to know your questions. And while you guys are typing in your questions, I just want to let you know that if you want to see our deal flow, check out goodinvestments.com/invest. If you're not already on our deal flow list, go over there and fill out our 10-second application. That just helps us to get to know you better and your investing goals. And then after that, we can hop on a quick phone call with you. But the Goodegg Investor Club is for anybody, whether you're starting out, doing this on the side, haven't done a deal yet, or you're a pro and got many deals under your belt. All right, guys, jump over in the chat box. This is pretty heavy, dense information, but it is something that I really love going over with investors and making sure that they fully understand the nuances of each individual deal and what it can look like and how it can impact their overall general return. All right, guys, here's my information as well. And I only hang out here for a couple minutes, field your questions, and if you need to take off, thank you so much for joining, and thank you so much for spending your most valuable resource with me, which is your time. Can I expand on the 70% to 13% IRR, 50% after? Does that mean that once the designated IRR is hit, the splits? Yes. Okay. So Kevin, yeah. So exactly, I'll not speed through that in reframing. Here, in this particular case, and you'll see this is this is pretty common, to have an IRR hurdle in a lot of multifamily deals. I haven't seen it so much in like mobile home parks or self-storage, but you'll see, a preferred return. Okay, so the cash flow, it's a preferred return split 70-30 thereafter. Okay, in this particular example of a waterfall, but it's what happens to the capital on the back end, like the gain, right? So when the property sells, we're going to return all the capital to Class A. Okay, if there's a second class in here, we're going to return capital to them too, and then we're going to make up the preferred return on each class. All right. Then there might be like a distributable cash return to the general partnership as well. Okay, that's pretty common to see in there. And then there's a split. So once everybody kind of gets, Class A gets their capital back and preferred return. If there's a Class B, they get theirs too. General partnership gets a little bit slice of their pie. And then what's left over goes, there's 70% to the limited partner class, 30% to the general partner class, until the limited partner class hits a 13% IRR or a 15% IRR or 17, whatever that number is. And then all the cash past that hurdle, okay, gets split 50-50. So I generally see this type of IRR hurdle structure on deals where there's a value add component to the deal. And this is to help, reward, the limited partner can make a very hefty return on the deal, but also the general partner, can participate a little bit on the upside as well for their hard work throughout the hold. Can I go over when the delta is met? So in this particular case, in year one, we were saying we're only going to distribute 4.4%. Okay, this particular deal was a Class A deal, so it was going to take us a while to turn leases, okay, in order to be able to feel comfortable distributing 7%. So, but remember, the 7% was a preferred return on this for Class B. So the delta, 7% minus 4.4, that's 2.6%. Okay, that it gets suspended and can be paid out according to the PPM. And generally that'll be, say something like cumulative, and can be just, paid out via cash flow, capital event, or the sale of the property. Okay. Do I usually prefer deals where the GP has a good portion of cash in the deal? Also, do you see this in the waterfall? So there's a perceived alignment if the general partnership is putting in, cash. For me, taking, my partner hat off and putting on my like limited partner hat, I like that. It creates like alignment. Now, where is the cash coming from? Is it above what they're making on their acquisition fee for the property? That's generally a question that I will ask. And the reason being, now think about it, the acquisition fee, generally keeps the lights on for the company. Okay, so the general partnership, they're doing all the work. They're finding the building. They've done all the due diligence on multiple buildings beforehand. They've been traveling, meeting with vendors. They've been doing all the work. And so for me, having been on this side of the equation, I now fully understand all what goes into putting a deal, this size, like 65 million plus deal together. So I think it's fair that they get paid. Now, it does, again, I do like the fact that they have skin in the game as well. Okay. It's not necessarily a deal breaker for me. If they say they aren't putting money in, I then want to know why. Okay. And there could be a very valid reason to that. Okay. Will I see their money in the waterfall? No, generally I won't. Okay. Because they will be part of the equity class, right? Generally they'll either in single tier or dual tier stack, they're taking up either part of the A or the B class, okay, as part of the down payment. Okay. All right. Woo. Let's see here. I think I got through everybody's questions. If you guys have more, I'll be happy to hang out here for a couple seconds or a couple minutes. But again, thank you so much for joining today. This has been awesome. And if you need to bug out, thank you so much, and we'll see you next week. Yeah, you guys are very welcome.